Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office TV for old school podcasters. That would be also on Apple and Spotify as Angelo Robles Podcast, and for my beloved members of SFO Continuity, welcome, where they also get the opportunity, in most cases, to interact live with our guests as well. So go to angelorobles.com and learn more. We have a very fortunate session today, and really it's even far deeper and more interactive than the title gives it credit for, but there's only so much room in a thumbnail. Today's session, harnessing market reflexivity to outperform the crowd and manage risk. Our special guest today is David Kalk, founder and CIO of Reflexive Capital. I'm going to do a little bit of a bio read because I think it's important to understand the context for our conversation that we're going to have today. The organization is an alternative asset management firm focused on crypto. David oversees the macro direction liquid strategy, where he leverages his deep professional trading experience and macro expertise for macro regime identification, asset filtering, fundamental diligence, active management, and proprietary risk management. Before starting his firm, David served as the head of macro and digital assets at Commonwealth Asset Management. Prior to that, David traded macro for 8 years for Peter Thiel's family office, Thiel Macro, progressing to also serve as the CIO for the latter 4 years. He began his career as an interest rate swap trader at Goldman Sachs and holds a BS in mechanical engineering from MIT. David, welcome to the show.
Thanks for having me.
It's a pleasure. Would love to get started. We have a lot to discuss. And for those of you that heard my open and like, one, David has an incredible background that is very deep. Yes, crypto is, of course, going to be an important part of our discussion. But as you heard from his background, there's a lot to learn from deeper thinking about the markets, macro perspective, and effectively for me, mitigating and managing risk from his experiences that is going to be valuable to all investors. On that note, David, can you talk, that I hinted at in the bio, about your family office background?
Yeah, sure. Thanks for having me. I worked at Peter's family office for 8 years, and as you said, was the macro fund CIO. It's a pretty unique setup there. The role was to engage in markets directly, so it wasn't in many ways that different than me being a macro trader at any other macro hedge fund, but definitely had some unique family office characteristics. And working with Peter, had the flexibility to do things a bit differently. With Peter, we tried to identify different ways of making money. You really learn to think for yourself, which is helpful in these really competitive macro markets with groupthink and herd behavior. But also it served me quite well as we moved into crypto, where you start to kind of need to write your own playbook on how to operate.
You have a very deep background. You've had opportunities in the world of finance and could have had what I would call a highly successful, even traditional career, maybe in classic long short and other hedge fund opportunities. But you decided to go down the road of crypto. And I think I would have to wonder, given your background and perspective and experiences, why?
Yeah, well, we can talk about that at depth, but like other macro guys, some of which I think have been on this series, there was an early attraction to Bitcoin because of this option convexity-like mindset. Back then it was not clear to anyone that it was going to be a big long-term thing, but if it did work out, it was probably going to be big and you should have a bet. And so it was something you could risk small to make big. And that's like a very clear macro mindset. Ended up getting much deeper into the space after leaving Peter's family office and starting Commonwealth Asset Management, which is another macro fund. I said this word macro, and it can mean different things these days in different setups. But I think the way to think about it is it's a flexible mandate. You're top down, you see the regime, and you find asymmetric risk reward. So at Commonwealth in late 2020, we identified crypto as a macro asset and set up some custom vehicles for our investors to get the trade right over the course of 2021. Because in that environment, it felt like to us in this everything bubble, it would be the fastest horse to be riding. And we ended up getting really deep into the space that year. And then for an even stronger set of views, that this was the most liquid, inefficient market. So typically what you find in markets is the more liquid it is, the more efficient it is. Crypto is a very large outlier because the big traditional players have made business decisions not to be involved to this point. So this is the thesis of my current fund called Reflexive Capital, which I won't talk about too much today, but it's this concept of market reflexivity, which to me meant we were going to have these repeated boom bust cycles, and the market would remain very, very inefficient around them because the big players aren't involved. And maybe this is like what it felt to trade in the 90s or the early 2000s, where there's edge to having a different mandate than everyone else, edge to being a risk manager, edge to being a professional. And at this point, I like having these types of discussions because I have a pretty sober read, I think, on what's going on, and it ends up being a very differentiated view based on my skill set and my modeling of what's actually happening. And it's meant to be a very bullish take for someone in my seat. Irrational is good, plenty of opportunity if you can embrace this, but for other people, I might just feed into their skepticism, which is fine as well.
And you gave a description of macro, at least from your perspective. Talk a little bit more about how you define reflexivity.
Yeah. So kind of gets this part of the discussion. I'll just say, these are just my opinions and it's not meant to be financial advice or opinions of my fund. But yeah, I named my fund after this concept of market reflexivity because it's the core framework and really it's the lens at which I look through everything at. And, in my 15-year career trading macro, you're always trying to understand these patterns and position yourself around momentum and cycles. You want to track the allocation of capital. And then I came to crypto and here it's literally the most important dynamic. And it might explain the whole thing. And so it's really useful for any crypto discussion to start here. But it also, we can broaden back out because it's like the most extreme version of this, which you can use, I think, to apply to all sorts of other asset classes and allocation decisions. But this concept of market reflexivity, it runs counter to efficient market theories. And the idea is that everyone has distorted views of what's going on in markets. Price can heavily distort people's views. People start paying attention when price goes up. Your friends start talking about there's FOMO, but the fundamentals start improving when price goes up. And that actually reinforces higher price. So, you have this feedback loop which develops where price goes up, the fundamentals get better, people buy. So then price goes up even more, fundamentals get even better, and people buy. And that feedback loop is self-reinforcing. And of course, it can all work in reverse, but it's this overshooting and undershooting related to this feedback loop, which creates the boom bust along some trend.
And I think a very important question that I like to do early, because I think it's going to be very important as a giveaway effectively to mainly the ultra high net worth investors and family offices. Can you provide a non-crypto example of a reflexivity and explain how family offices can apply this concept to their broader portfolios?
Yeah, so you think about situations where the borrower's creditworthiness is positively affected by more lending. So the housing market's an easy example to start with, where when there's higher home prices, that means you can get a bit bigger mortgages. And, there's the psychological belief that housing is a better investment, leading to higher prices, but that allows people to borrow more and buy more expensive houses. Credit can often play very large roles in these cycles. When the economy is good and you have a period of low defaults, that leads to tighter credit spreads, and that makes it easier to refinance and issue more debt. And default can then be delayed, and that also can reinforce investor beliefs. But then you end up with more leverage in the system, which makes it more likely to default over time. And so you think about the Asian debt crisis or the European sovereign crisis. This all ends up going bust at the end. And the last example would be, I'd say, kind of big disruptive tech stocks. When people start valuing things based on the long-term potential for things, they're especially prone to this dynamic. When the market's saying you don't need to be profitable at all short-term, and you just start looking for things like users and network effects, what you have is this pattern where higher prices leads to more investor enthusiasm, means the cost of capital goes down. So basically, you're a company, you can raise a bigger round at a higher valuation, and then you can just use that as your customer acquisition budget. And so you can see how that can also end up being a feedback loop. And then, you get to crypto, which is the most reflexive asset class.
Why is it particularly exaggerated, if that's the right word, in the crypto markets compared to traditional asset classes?
Yeah, no, like exaggerated, maybe just like can deviate the furthest from equilibrium or from trend. So in crypto, when you have these feedback loops which start working, it can literally take us anywhere. I mean, we don't have any real shared valuation heuristic on how to value this stuff. It's not like price starts moving and then it runs into some semblance of a PE ratio. And so, really, there are no bounds around how much reflexivity can work. And then when you look at the actual fundamental analysis people are doing in the space, the most commonly used metrics, TVL, the dollar value of something locked in a protocol on the blockchain, token price triples, literally that metric triples. Speculators are often looking for network effects. And what they see is that their users, in most cases, responding to the short-term incentives of a protocol. When a new token is launched, you basically offer some of those tokens to the users to come and use your protocol. If the token price triples, the dollar incentive triples, and then maybe users come just use it to get that incentive and move on to use something else. All these have a very strong relationship with price. And then you come to the allocators, and we talk about that at length today. The way allocators deal with this asset class is basically to do nothing for the last 2 years, and then start chasing price in some crazy way. And so I would expect this pattern to continue, for the most part, because of the way allocators behave, in combination with the fact that there's a lack of fundamentals that can really anchor price in either direction.
What are fundamentals in crypto? And probably a little bit of a part two to that. How do you value crypto?
Yeah, I gave like a few examples, which are most common. There are attempts to value these things like equities, but the market just isn't there yet. I see no connection between any of those valuation frameworks and any trade that the market is doing. Maybe there's some parallel of these big network effect equities where when you're looking for network effects in consumer internet, maybe you can apply those models to crypto. But yeah, the way I like to think about it is it's like a commodity, and it's all about supply and demand, where maybe there's some intrinsic value anchor, but really, again, supply and demand. So on the supply side, you have unlocks and emissions. Sometimes that's pretty relevant, but the demand side seems to dominate, and specifically, it's the psychology of the market which dictates the speculative demand. Because we're in this phase of in advance of real usage, and this is like something like in oil, where there are some people who sit there counting barrels. Libyan supply is going to come online in 2027, and that's going to be bearish. Well, those people never make money. It's really who understands the Chinese industrial cycle to make a speculative view around the global macro cycle. And crypto is going to be like this probably until you have more actual usage of the token. You go to this idea where there are more people speculating about usage in crypto than actual people using crypto itself. And so until you sort of recalibrate those things, my guess is this is the right model to use.
And just so I could clarify for the audience and maybe your specific focus in terms of your experiences, when you mention crypto, are you open to quote unquote a variety, technically hundreds to thousands of so-called different cryptos, or is it focused on Bitcoin and perhaps one or two others?
Yeah, I think there are two discussions to have that I think would be relevant. Which get to one will be around the role of Bitcoin, and then one will be around the rest of the stuff. And then certainly my views will apply on in my opinion, how one should think about going about the rest of the space. But then one of the issues, which there's a tension in, is the fact that these things are correlated. And certainly there's a question of how you would manage those two things. But yeah, for the most part, I think my characterization is around the rest of the space. And in some ways it can be applied to Bitcoin itself, but Bitcoin has found quite a resilient, it's the best meme coin or something, but it's probably not going anywhere. And so it has somewhat more stable economics than the rest of the stuff, which I think is more interesting to discuss.
Yes, and perhaps a little later in our discussion, we'll be able to break some of that down. In crypto, what are some of the specific signs that reflexivity is leading to outsized risk or henceforth opportunities?
So remember, it's like there's a trader mindset and an allocator mindset, and I'm not sure any of this is useful unless you're really engaged in the market. But the trading opportunity is you sort of want to ride the wave, and allocating can be more difficult. But we'll come back to that. I mean, in crypto, this reflexivity is it's an amazing trading pattern if you focus on it, and it's perfect for this macro framework where, especially because most people I find in the space have a much different time horizon. People are either really long term or really, really short term. This reflexivity helps drive momentum in the space. And so really you want to look for signs that the price is moving sufficiently to reinforce the whole feedback loop. And so you can look for early signs of capital flow. I mean, we've been in this period right now where there's been almost none for a few years. And it's the beginning of the pattern that's the best time to enter. And I would argue that's the better time than just trying to catch the falling knife. I think kind of catching the bottom and top, that's the wrong mental model for something with such momentum characteristics as crypto. And then, you have some pattern where it lasts for 6 to 12 months. Historically, Bitcoin performs first, and then you have this rotation into altcoins for the second half. But the returns are obscene if you can not be late, and then, of course, get out, because the risk is when this has been running for a long time, on one hand, the longer it's been running, the more vulnerable it is to reversal. Likely you've a bunch of leverage built into the system. That was the lesson from 2021, by the way, is that there was all this lending from BlockFi and Celsius and all these lending desks.
Yes.
But the stuff can keep going much longer than you'd expect. And so I wouldn't short it, but you wait for there to be a catalyst for a price reversal. And so personally, the way I manage it with a bunch of indicators, I think about the stuff every day. But the nice thing at the end of the cycle is that everybody gets so drunk. It can be so easy to be a contrarian and get out. And I can point to a bunch of stuff in hindsight that we used last cycle. Maybe you could just see how many podcasts Angela's doing or something. If on the 7th crypto podcast, that's your indicator to get out. I don't know how many you've done this year, but.
Well, as my old guard audience would know, that's been with me a while, during kind of that 2020 during COVID. And you mentioned a verbiage that I heard someone in my backyard who I did interview in person years ago. That would be the iconic Paul Tudor Jones talk about his interest. And even recently, he did a pretty prominent interview where he spoke about things like Bitcoin and gold and some of the challenges that we're going to be facing. That may be more of a bigger geopolitical and macro discussion. We'll see how it can weave into what we're doing today. But that window of about 18 months through my Michael Saylor interview in 2021, I might have did 50 programs on it. Okay, 2022 came and was a little more challenging. I don't do as much in crypto anymore, but I am going to have a comment relative to that and your feedback on it coming up very shortly. Meantime, being a little bit sequential, trying to build up the momentum to the audience, what role does macro play? You kind of already hinted at it, but maybe a little deeper dive. What role does macro play in crypto cycles?
Yeah, so there's all these macro patterns which fit really well, as I mentioned. But in this reflexivity model, when you want to understand this relationship with the cross asset macro, the two most important macro questions: what's the Fed doing, and how many houses are they building in China? That sort of stuff matters at the extremes, and that at the extremes can help catalyze regime change, and then it can just be really, really self-fulfilling. And so in many cases, you have these big macro events help catalyze a Bitcoin cycle because of some extreme shift in monetary policy or banking issues, and that's how adoption trades start to progress, which progresses into something new over time. Global liquidity seems to play a very large role in both directions, as this is the thing furthest out the risk curve. But I tend to think about it just the extremes. Not like you have to sit here and watch the jobs number every month when you're well within a crypto cycle.
And this will probably lead into what I hinted at a little while ago to a comment and question for you, but this will build into it. How should family offices prepare themselves psychologically to deal with the extreme reflexivity in crypto markets?
Yeah, so the best setup, maybe it's easier said than done, is just to be realistic and sober about this space and have something like this framework down. And then you're in such a better position in both directions. And of course, you're subject to fear and greed, like anything. But understanding this pattern, how it can reverse and then be self-fulfilling in the opposite way at any moment, leads to a much more rational approach. And one of the challenges, though, is it's really hard because in crypto, it's like everyone in crypto is in a cult. and it's like there's almost no sobriety, and there's all this religion. People align their whole identity with the space, and I guess that helps form a very consistent user base. This is one of the reasons it never goes away, because in the bear markets, these people stick around. But it also makes it really hard to find rational outputs. At the peak of this market, it feels like it's going to take over JP Morgan. And then at the bottom, it seems like it's done forever. But to me, trading is all about psychology. It's about being open-minded and changing your mind, listening to the market. And I don't think you can be ideological about anything if you want to make good decisions and try to manage risk.
True, although it may be a little off topic. I heard Mark Andreessen in a podcast on Tom Bilyeu today, where he actually used some of that same verbiage relative to a cult, relative to a new age religion, to a lot of quote unquote younger people. It was in a little different context, but as you brought it up, it clicked in my mind. We may get a little bit into memes and all that, and how there's a dynamic changing in the community that probably leads into the question that I've been hinting at, but one more building into it that builds the story, everyone. Many family offices have a preference for long-term assets. We know this. How can they adjust to the highly cyclical and reflexive nature of crypto investments? It's different for them.
Yeah, I didn't listen to Mark's interview. Yeah, but I think, as I say, there's something really important about the religion. I just think there's an opportunity to have a different perspective, because in most cases, the religion seems to be the it's easy to be contrarian if you're not in the cult, sort of 1 foot in, 1 foot out. But yeah, on your question about long term, honestly, at this point, like literally today, I'm a bit measured about long term holds in the space. And let's put Bitcoin aside for a second, come back to that. 99% of the stuff is going to zero. And so you have to have a shorter time horizon in most cases. And part of this is because, these tokens, I think they can be counter to long-term sustainable economics. So much adoption is around speculation, and the activity, it responds to the boom bust profile. There's prevailing wisdom that really you're not supposed to overtrade this stuff. Although honestly, I think there's a lot of cognitive bias where people are speaking about the issues of trading when it's come to Bitcoin and Ethereum, and then applying it to basically everything else. But the other reason I'm measured about the really long-term form of investing is that you've had such a large capital allocation into long-term mandates and private markets that you could argue, definitely in a relative sense, but maybe in an outright sense, that there's just too much money right now for the opportunity for these funds to perform anywhere near as well as the track records that they're putting out there. If you think about the sheer entry points of the trades that you're getting into, is there enough potential return to absorb the boom bust and still be ahead? Like if you're getting in the seed round is $200 million as opposed to $20 million, I would try to be adjust away from this part of the market, particularly in large VC funds who have to allocate at much later stages. Again, maybe do some, but it's too big of a position given it's been the main way that most people have entered the space. Before 2021, it was probably the obvious way to enter. So, because to me, this stuff is meant to be traded, and if you actually adjust to trading strategies as they become available, there are only a few professionals here, but more are coming. That can probably play a pretty strong role in the portfolio. And yeah, just to quickly touch on Bitcoin, that can certainly play a very valuable long-term role in people's portfolios if held for the right long-term reasons. But you just need to expect a really uncomfortable volatility profile going from cycle to cycle. It's not, in my view, not expected to escape that anytime soon.
And not the focus for today, go back to some of my older, if they're more family office viewers, that gives a breakdown of proof of work and some of the concepts behind Bitcoin, in my opinion, having escape velocity, getting institutional adoption, quote unquote, the spot ETF. So there's lots going on there. All that being said, I'm building up into the comment and question as someone who's been an active allocator in the space, including in not the top 10, although partially the top 10, but others that are more esoteric that really, like you said, probably have no true utility, but they develop through supply and demand and the nuances in markets, opportunities where, at least with modest amounts of money, there's massive amounts uh, of up and down and opportunities to quote unquote make money. We all know quote unquote crypto bros now often in Miami that have, $100 million plus net worths that basically come from nothing. But I have to focus on the fact that even in the heyday, or perceived as such, 2020 into 21, and someone who was traditional, who is a suit and tie guy, had a hard time, other than maybe Bitcoin, getting adoption among family offices into broadly the world of crypto. Breaking that down, most of them, and this is a principal and agent problem, most of them are executives, non-bloodline, working in a family office. You could relate to that. Mm-hmm. And, this may be cool, but I'm a little older. I'm busy. Do I have time to do a deep dive and form a thesis? And I don't quite get it. Like, I can't see, feel, and touch it. I have nothing but risk getting into it. And of course, if we put even 1% and the principal notes that how come this asset's down 13% this quarter, I'm probably going to hear shit for it. Therefore, I actually had way better success with the principles of money that created the wealth in 5 minutes, making a decision. Yes, let's put 1% into that. But you have to get through the gatekeeper of the CIO, sometimes committees. And it was very hard. And again, I think they're wrong, but nonetheless, this is a challenge that you went through to some degree as a non-bloodline executive in a prominent billionaire's family office. Do you think this is an inherent kind of principal and agent problem?
And that it's certainly a problem. And I guess for as difficult a time as family offices have had, they still remain best suited to adopt early. And I guess, there's this progression of capital allocation, and we're saying that nobody really allocates until price is going higher, but there still are different speeds. And when there's a real investment committee, which I find more common at some of these large institutions, they end up having to wait till an even more mature stage of the cycle than at a family office, right? And it's like, in order to create advocacy, everyone has incentive issues, but to create advocacy in such a risky thing, when half the other committee thinks crypto is a total scam, it takes even much longer. Like, there need to be much stronger narratives and much more price momentum for them to actually do anything. So I do think, family offices are still well positioned to move sooner at an earlier stage of reflexivity, or God forbid the bear market. But, singles, the closer you can have to a single decision maker or having the right incentives, the better. But yeah, I know that doesn't actually reflect the median family office.
For sure. And actually, family offices and first movers are a subject we're going to do a little bit of a deep dive into very, very shortly. So that'll be a good buildup in terms of what I said. But staying a little bit on topic to kind of crypto markets and reflexivity, what role does allocators like family offices play in driving reflexivity in the crypto markets? And does their entry or exit impact the cycles if it's large enough?
Yes, I mean, the model here is that reflexivity is about how allocators change the underlying return of asset classes. So the capital flow is the key driver of price feeding back into fundamentals. This feedback loop thing I just keep coming back to. But the family offices can be first, but the ability for allocators to come in, like, that's the amount they're coming in and the sizes they're coming in, that's the same as the price profile within these boom bust asset classes, where it's just spurts of allocation that are very concentrated in these periods and helping drive the whole thing. There's also a specific issue where family offices and a few other allocators, they have this preference for investing in things, which you can hindsight's 2020, but things like BlockFi and Celsius, and there'll be some new version of that this cycle where someone tries to do risk transformation of credit and counterparty risk and turn it into yield, and oftentimes it's misrepresented because when reflexivity turns, this stuff it is always in trouble. It's it's not clear you're getting paid to take that risk, but it can have this very important impact on the cycle because that's the leverage that the system needs for people to start going levered long. And then that ends up being a big part. The deleveraging itself is one of the biggest parts of the bear market. What's interesting is I don't actually track that much money ever leaving crypto. It's kind of this thing where money comes in and then it never leaves, but it's the deleveraging which ends up being most of the selling in a bear market. And allocators clearly play a large role because of the way they try to come into the space sometimes.
Going back into that ultra high net worth investor, family offices, and again, your background and experience in it, and we hinted at it a little while ago, some of the challenges of principal and agent issues and being a first mover. I mean, family offices, you would think, have the advantage over institutional investors because simply they can make quicker decisions. But if there's less moving parts going to a final decision maker, and sometimes it is the CIO, that is simply it. They have the opportunity of making swift decisions in dynamic markets. Now, how many of them are actively doing that? It's greater than 1%, but it's a hell of a lot less than 50%. It's not a huge number. Again, they're going to look at it as the family's already rich. I may not be extra rewarded for taking certain risk in esoteric asset classes that are not quite understood either by the principal or maybe even themselves. You look at some of the people in investment committees, like, really? Like they're all, like 70 years old? No offense. Great experiences, may be wonderful in certain asset classes. They're not really going to get, for the most part, tech and crypto. So how do you address those issues? And the reality is maybe only a small percentage of families, 7 or 10%, are going to be earlier and first movers.
Yep. I actually don't even have a good answer. I mean, I spent a bunch of time trying to have this conversation with people in late 22 and for most of 2023. And yeah, it just comes back to what you said, that it appears that no one's really incentivized to take a big risk on what looks like a dead industry within most of these firms. And so the countercyclical thing is really, really hard. I think there's maybe some ways that you can formulaically try to commit to doing that. But the thing about this reflexivity is, it just overshoots the downside as well. And so it just really starts to feel like nothing's coming back. And you could say that today about crypto outside of Bitcoin. I mean, we should talk about where I think we are in the crypto cycle, but there still is quite a bit of pessimism around the non-Bitcoin crypto space in a way that, it still feels like this should be the time people are considering allocating, but people are waiting until they see something even more interesting than they see now.
I think the current subject in first movers is still important, but you're correct. Understanding market cycles and reflexivity and asset classes actually is the next subsection, probably in just a couple of short more minutes coming up. Staying on that topic a little bit, though, how can family offices avoid falling into the trap of herd mentality, especially in highly volatile sectors like crypto? And how do family offices avoid overreacting during reflexivity? Now, again, you would think families are long-term investors. Sometimes I may be meaning 10 years, 30 years, generations. Yet nonetheless, again, there is that challenge, and you have the experience of working in one, although again, with someone who is a unique principal. This is still, and it probably builds up upon the last question I asked. Let's just say that we have a family office executive listening in. They're willing to be a little bit more open-minded. How would you suggest that they become a little bit more adaptive as an earlier mover? And by the way, when I had Raul Paul on, he probably had the best answer, which is so simplistic. Why don't you start with under 1%?
Yeah, and I think the option-like framework is probably the right one. If you can size it where it doesn't really matter, it can still work out for you quite well. I mean, but because it feels like everyone's story who's made an allocation is basically the same, where the first time they came in, they lost money. And they came in sometime between June and December of 2021, or even in late 2022, and sometimes that actually enables people to engage a little bit better the next time around, because they learn enough in those few months that they don't throw away all their notes, that when the next cycle starts they can do somewhat better. But yeah, I mean, really, one of the reasons I spent a lot of time kind of presenting the sober views, where it's actually just it's not meant to throw this asset class away. It's meant to try to identify the idea that the market's likely to go up again, and when it does, it's probably going to go up quite a bit. So in every family office is different with respect to how to manage the politics. But maintaining a persistent commitment at some size, to Raul's point, maybe it's just really, really small, and then using that to allocate at different times than the peak, which is what happens when you're just a cyclical tourist. Don't make it about picking the bottom, just kind of getting in when the markets do some sort of correction. Again, easier said than done, but however you can achieve something like that. And the tricky part is, we just spent a lot of the last 2 years and even today having that conversation, and it doesn't feel like there's any panacea.
What are the specific challenges, I could argue maybe opportunities too, that family offices face when moving faster than larger institutions, which you would think would have more layers of bureaucracy, into something like crypto and other fast-moving sectors?
This is the problem for some as well, is that, okay, you decide you're going to try to find a manager, and then you come into the space and it's just a bunch of amateurs, basically, and you're trying to underwrite into a complicated asset class with a complicated set of managers who have short track records. Have they even managed a bear market before? So the diligence in this asset class is even more important, but extra complicated. And it's not clear a lot of family offices are equipped to do that diligence. And so there are third parties, whether they're consultants or even relying on some fund of funds, which in this asset class probably make some sense to include in this allocation process. Because the diligence is more important, but it's just much harder. And when you're moving before the big institutions, you can't really rely on them either. And then when price starts moving, of course, the bar for diligence comes way down. But when you're moving early, you have to find ways to engage in that process, which if you can't have like a full-time crypto person, can be really complicated.
Actually, since you brought that up a couple of years ago, I ended up being wrong, which happens a fair amount. I basically stated that we're at the stage where family offices should consider, under the auspice of a CIO, effectively having a crypto specialist. Like they may have a direct deals person, a real estate person. Of course, it got laughed at. In theory, it never really took off. And to this day, and maybe things will change in the future, I wonder why. How do you know that you couldn't get someone that maybe starts off very small, theoretically under 1%, and maybe moves to 2%, to 5%, to 7%, and outperforms over a block of 3, 5, or 10 years, practically every other part of the portfolio, and you have that insider that is heavily incentivized on quote unquote the upside? That never really happened. Do you see a future where family offices could have something like that?
Maybe you can, if it's too much to have a single individual rely on an external party to manage that. The inside baseball is tough. I mean, with Peter, we always just had flexibility to design exactly what you're describing. But the ability to think outside of the mold was certainly a prominent feature of that place. I don't have a strong sense of, if you're going to okay, so you're going to go hire a crypto person in the bear market to make those allocations. That feels like an even stronger commitment versus, if you hire a crypto individual in the fall of 21, because how long does it take you to get set up in that way? And so maybe you need to rely on other parties, because the whole thing here is we can't add new wrinkles to slow down an allocation process unless you're doing so very counter-cyclically. And I see almost no evidence of that.
Maybe a little bit of a risk management question that talks about structures. And my real love, honestly, is the very boring world of being productive and best practices inside structuring a family office. Could I make the argument, and let me know from your experiences, from the perspective of, we do this, we're chronicling it, we have a system in place, and it works or it doesn't work out. When it doesn't work out, do you overanalyze why it didn't work out? Do you then create additional systems if you or others move on that could be tracked to see, here's mistakes we made. Here's the problem with that. It sounds wonderful. Now imagine 5 years, 10 years, 15 years go by. You have systems after systems after systems on every little thing. You have a wickedly bureaucratic family office that didn't adapt to how things change to when maybe that idea or trade or thing didn't work out a year or 10 years ago, and that's going to be reflective of a nimble family office? I chuckle and laugh at that all the time. Am I wrong, David?
Yeah, no, I don't know. I don't think you're wrong, but it's man, I think it's complicated for most family offices to get set up in this way. And yeah, that's probably why there's just a lot of herd behavior.
Yes, and that really is what it comes down to, what I would effectively call herd behavior. Given crypto's volatility, which for sure is the case, how can family offices create a balanced portfolio that hedges against both reflexive bubbles and crashes?
Yeah, so if I think this momentum reflexivity approach creates that balance, but that's sort of a trader approach, and so the balance becomes hard. And there aren't that many like smart beta products which can help you, because the whole idea would be to not have your whole portfolio being, fully, have one beta and fully correlated to the market. Some buy and hold things. So if I were to, not financial advice, kind of create my own portfolio, I think Bitcoin in a buy and hold sense makes a lot of sense for a lot of long-term reasons. Venture, I mean, it does suppress volatility because they don't mark anything. So that's like a nice instrument in that way. And that's probably why so much money's flowed there. And if venture's done right, you can invest through the bear market and have really nice balanced characteristics. But yeah, I personally like having this type of trading strategy to swing the portfolio in the right ways, finding ways to outsource the trading part to someone involved. So yeah, some version of like Bitcoin buy and hold, some smart beta swing trading product, and then a VC which invests in 2022 and not 2021.
And I promised I would come back to kind of understanding market cycles and reflexivity in asset classes. So therefore, how can family offices apply reflexivity models from crypto to traditional asset classes, real estate or equities?
Yeah, so if you take all of this discussion and apply it to other things, it matters somewhat more at the margin, but I think still can be very useful because I think if you understand market psychology and you're aware of biases and irrational behavior, FOMO and greed, really there's this mimetic desire with investors, and because of insecurity, like insecurity turns into greed when people feel left out of things. And whenever you have these shared emotions, that creates a lot of volatility. And so to me, as a result, markets are always a sequence of boom bust sequence. It's just sequences of boom bust. And so if your approach falls a victim to reflexivity, you can get set up to fail every time. So certainly you want to make informed decisions by understanding this. And it's easy to say you'll just avoid it, but I always question, like, can you afford not to participate, or you just end up FOMOing later? And so, try to pay attention to emerging trends. Maybe just put some on early to avoid FOMOing later, going back to the 0.5% or something like that. Because by the time it's like fully consensus, it's just a really complicated time to make money, even if it keeps going, because your entry point is going to be so different than the people who entered 6 months ago, where even if it keeps working for 6 more months, you're still now on the wrong side of the drawdown on the other side of that.
How can family offices apply what I would call your concept of reflexivity to strategic asset allocation, particularly in high growth sectors like AI or technology infrastructure overall?
I mean, this is certainly happening in AI right now and all the associated infrastructure, but I guess it doesn't have to be a bad thing. The classic example is Amazon, which really utilized the tech cycles, the reflexive cycles to raise capital efficiently to build for the long term. And so what I'm saying is it's possible to make good decisions with it. And I think there's a decent chance that happens with AI. You just think about it, there's just some trend with these bubbles. And so if companies can successfully use the lower cost of capital, even if we have a correction in AI, and then, you plan for the winter and then wait for the next bubble, then you can be net better off than if this wasn't going on. And so there's a chance that plays here.
What common signs should investors watch for to avoid, let's call it a sucker trades or oversaturated opportunities in various markets?
Yeah, I mean, I guess there's all these heuristics, like if something's on The Economist or whatever. But yeah, I'd say like generally, you got to be careful when there's a lot of complacency and something is so consensus. I mean, this is the big thing we did with Peter, where you really just you found that most consensus, most places with most complacency, places with the most complacency, and then tried to turn everything upside down. But yeah, I'd argue if there's a lot of momentum and nobody can come up with a reason why it should stop working, that's a pretty dangerous sign. And you can think about more recently the chase into privates in the late 2010s and then in the pandemic period. People just got stuck being very late entrants and stuff that went down quite a bit. I don't know what the candidates would be right now. Private credit, AI, you said probably happening. I don't know if that's a sucker trade. There's good discussions about these prices, but there's always a trade, which I think it makes sense to really think critically about.
Can you explain how understanding market cycles through a reflexivity lens helps family offices manage long-term risk in their portfolios?
Yeah, so one of the things which is tricky is for Bitcoin, for example, I think that the role Bitcoin can play in a portfolio is to address long-term risks in portfolios, but it has these like really vicious drawdowns. So even things with secular trends can have this cycle behavior. And so, yeah, I think just being aware of that and finding ways to allocate things that are subject to market, allocate things over the appropriate time horizon so that market cycles don't get you out of the trade. Because there's a way in which some people got out in the second half of 2021, Bitcoin, they felt good about it, and then they just never got back in. And then now they don't have the Bitcoin, which is supposed to be there for, these big geopolitical events or, dollar devaluation, all these other themes. I guess the other answer is to, if you want to have some of the other long-term risk conversation, maybe just start to think over, is there long-term reflexivity supporting things like house prices and bond yields? No reason to be a doomsday about either of those things. I mean, maybe some people think that's happening in bond yields now as a reversal in kind of this bond bull market, which benefited from a bit of reflexivity at the government level. And then, housing has these demographic discussions, but, certainly these are long-term risks. But the nice thing is I actually think Bitcoin plays a very unique role in solving against a lot of these things and has an important role in portfolios.
Where do you think we are in the crypto cycle?
Yeah, so I guess the short answer is I don't think it's started yet. And I don't do this astrology around the halving. I would say the cycles, they start with Bitcoin in all cases because it has the most resilient narrative, is what we said, it's the best meme. And what we've seen is, like previous cycles here, Bitcoin has gone up first and the market starts undergoing a big psychological shift. So this hot ball of money forms and you start to see price and fundamentals reinforcing themselves all over the place. And so that's sort of where we are now, where the space is churning pretty well. You have new behaviors, you have new assets, you have people responding to incentives in new ways. But the space collectively, again, outside of Bitcoin, is still looking for a new narrative that gets people outside of crypto excited. You need like a new paradigm. My basic heuristic is nobody allocates to the last bubble. It all just feels right now too similar to last cycle. It's literally a lot of the same tokens. And so right now we have this incomplete feedback loop because there's almost no money coming in to the space. There's some people that are ready to call the top of the cycle. We don't have a large amount of new risk, which has come in and established itself at bad levels, which is what creates the cycle vulnerability. On the other hand, we just still have quite a bit of momentum probably in Bitcoin. And there's a lot of things working for Bitcoin right now. So I think there's not guaranteed, but there's a lot of time on the clock for the cycle to find some new identity and some new reason for people to relate to crypto in new ways. And that's how the cycle really starts. Like the full foundation of reflexivity is there, but we've been lacking that catalyst. I mean, the election is 10 days away or whatever, and that's certainly has some potential to change things.
Well, since you brought that up, how do you think upcoming political events like the US election will act as catalysts for Bitcoin and maybe even more broadly, crypto markets?
Yeah, been a lot of people have been describing the election as a positive catalyst, which I would agree with. Trump's established himself as a crypto candidate, and so really even just like
Who would have thought it?
I mean, maybe not even him back in April, but
Right after the Bitcoin conference, everything changed,
he
and
picks
other
up
factors.
median voters quite well. But yeah, I think like the election itself, sitting here as a trader, it actually feels like, not financial advice, a very good risk reward, because if the election's probably too close to call, in my opinion, but there's an asymmetry around even the immediate price response, where it sort of feels like a 3-to-1 risk reward, depending on exactly what asset and how you structure it. There's a lot of allocators which struggle with the binary nature of things. I've noticed this in my recent conversation, which is kind of frustrating because in my mindset, this is all I've ever looked for is a coin flip with 3-to-1 risk reward. But I would expect some immediate inflows into the majors on a Trump victory, with some crypto funds recycling some of that money into altcoins, and that starts to feel very ripe for reversal at this point. And I'd say that the most interesting thing though is the potential catalyst around a regulator shift to allow for a new paradigm in the space. So the big macro question we just said is, how do we get new money to come in? Capital flows are missing. There's pessimism everywhere around the space because money's not coming in. But these cycles are often about new forms of tokens, innovation on the distribution of tokens or the characteristics of tokens. You think about like the ICOs or, then the smart contract protocols and then the NFTs. And so I think the next stage, it could be something about a new regulatory regime enabling new forms of tokenomics that seem more productive, investable, and importantly different. And now you can look back at the last cycle and say, we had these bad tokens because of the regulator, and now we have a regulator who wants to help us create more productive tokens. And that would be enough to for people to start to relate to the space in new ways around new sectors. And again, price leads and narratives start to follow. And then if reflexivity catches, it's game on. And so I think it's quite exciting and something to be prepared for. It's not clear if it happens like in the first 72 hours of whenever the election is resolved, but you could imagine as the transition team comes in and starts to discuss their appointees and the plan, that these things can start to percolate quite strongly.
I'm assuming, basically implying that likely if Trump wins, and depending on how it plays out, he's going to have his own choices for a variety of positions, including the fact that it's not a surprise, or maybe it is after the fact, that Gensler has not necessarily been overly favorable to crypto, and likely per Trump's comments, he would go in a different direction. In reality, we sometimes just don't know until it actually happens. But nonetheless, I think those are fair things to consider, which you basically said in a very eloquent, nice way.
Yeah, people that are being rumored, a lot of them have previous experience supporting crypto. And the perception is that a new regulator would make it easier for token issuers to register and not avoid certain token characteristics that would put them on the wrong side of the law, I guess would be how I'd put it.
Correct. And not the focus of our discussion today, but I think the audience, I'll give them a little bit. That is huge. There's a variety of different factors there relative to blockchain, to potentially what NFTs really could be, which is a lot more than a stupid, quote unquote, digital art. But the concept of fractionalization, of tokenization of real world assets is a real thing. Whether it happens 6 months, a year, 5 years, 10 years, I'm not really sure. But to assume that the industry, broadly Web3 and crypto, that would be massive. And again, I want to wake up families. By the way, I'm okay with you as a family office saying no. That might even be the right call for you. I only ask that you be aware and that you form a thesis and you back up why it's yes or no. And like I said, a little bit what Rails said and others, although I'm a little bit believer of jumping in and not being too small of an allocation, if it makes you feel more comfortable initially, it probably isn't the worst idea in the world. Moving on. How important is position sizing in emerging asset classes like crypto? And how can family offices determine the right amount of exposure and how to manage that?
Yeah, I mean, there's this different volatility profile, and this is one where I think family offices should be able to act differently. If it's 3 times as volatile as something else in your portfolio, just do 1/3 as much, and that allows you to hopefully get involved earlier before vol comes down. Because there are many people who the vol, they can't. Every quarter they get together, they have an investment committee meeting, and they sort by the worst performer in percentage terms. They can't actually adjust for the fact that they've done less, and nobody wants to set themselves up to talk about the down 50% in Q1 2022 because they had to make the investment at the same size as everything else. And so I think like the flexibility of family office to be able to just do the right amount based on the volatility, and again, choose your low single digit percentage. That should be an advantage to allow family offices to move sooner than others, because there's no reason anything has to be too volatile. That's a trader mindset, but just size it differently.
In a reflexive kind of market, how do you suggest family offices size positions to avoid over concentration and risk dilution?
Yeah, so you gave an example earlier where someone puts 1% into something and then it becomes 7%. Good problem to have, I guess. But one sort of system which it runs counter to how I would do it, because I'm going to try to manage it myself. But if you actually just find a way to formulaically rebalance and arrange your positions, like there's a way that can force yourself to size counter-cyclically. That's worked out quite well for some people. So, if something goes from 1 to 7, but your range is 1 to 4 or something, taking it from 7 down to 4 in the bull market, and then if it goes down to 1, finding ways to size it back up. Just having that sort of system is probably better than the alternative. If you're not going to be in the market trading momentum, you can actually do the counter-cyclical thing. And so that's a suggestion I have, but it does require kind of a persistent relationship with the asset class.
I understand every family office is not in hyper-aggressive or aggressive mode, and I could argue be careful of that because the impact of loss of purchasing power through true inflation for the super rich, and although it may take decades, falling behind, and not everyone is going to be overly tactical either. But I don't quite get, and others, Munger and others have spoken about this. So if you have 50, 75, 100 different positions, so I'm assuming you have one best idea. So you're basically telling me that you have, in my example of 50, 49 other incredible ideas that are probably every bit as good as your quote unquote, your best idea. Now we could get into diversifying through sectors and asset classes. It's going to dampen volatility. It's all true. I don't know if it's necessarily and again, I go back to Munger and Buffett and others, maybe have a small basket and watch it closely. So if I had to now formulate that into a question, 25, we'll go with 25 different positions dilutes the impact of your best ideas. How can a family office balance concentration with diversification to protect against reflexive market shocks?
Preaching to the choir here, but it's like, I'm a trader. I've said that a lot. So it's just a different mindset. Like, traders are bad investors are bad traders. Like I can focus on 1 to 3 things. And so that's the extreme version of all this, where I don't even want anything else in my portfolio. But maybe if you're not being engaged, like if you're not engaging in that way, maybe diversification can be your friend. I think that there's an approach where the concentration and the calibration of conviction of ideas maybe operates over a different time horizon than most family offices are operating. Like if you're just doing pure investing, some sort of like balanced approach with the system we talked about in the last question, maybe that works better. It just depends how in tune with the market you are.
1 to 3 is going to be extreme for the majority of family offices. I'm pretty aggressive on being highly concentrated. I don't know if I have the guts to do what you just described, but it does sound very enticing. Why don't I phrase a question being very broad? Without mentioning any names, from your experience being a prominent person in what I would even describe the family office community and knowing principals other than ones you might have even worked for, would you say the most successful ones tend to be somewhat relatively concentrated as opposed to, oh, we have 115 best ideas and we're invested in 115 different things?
No, absolutely. I just absolutely. I would just say it's not a part-time job if that's what you're looking for. So yes, it works. It works if you do it the right way. It could maybe backfire if not. I don't know.
Munger's comment of have a small basket but watch it very, very closely, you would probably be a great advocate of.
Okay, I finally agree with him on one thing. So there we go.
Maybe not on technology, Bitcoin, and crypto. Yes, I found one though. Yeah. What are your thoughts? And this keeps on pounding that question, then we'll move on. What are your thoughts on concentration or concentrating investments in a few, I think we know the answer now, a few high conviction ideas versus spreading risk across multiple sectors?
Yeah, I'm not sure I have a different answer. I mean, that's it, I think I put it pretty clearly how I think it can be really powerful. And the macro community is probably the hedge fund group that's done this the best. Like really size up your bets the right way. I mean, you look at like all these equity hedge funds over the last 15 years. I mean, they should have owned 4 stocks, and it's complicated to do so, right? Because you're charging 2 and 20, you're just owning 4 stocks, and like all this other stuff. That's this macro person's superpower. So my thoughts are supportive if you feel prepared.
And taking it to the home stretch and a little bit more about you and what you're doing, how do you see reflexivity shaping broadly the concept of it, shaping the investment landscape in the next 5 or 10 years, particularly for family offices?
Yeah, so I hope this discussion, it's meant to, as I said, meant to be it's not meant to be discouraging about crypto. I look at this stuff, and you mentioned this before, like it's just a big opportunity as the market evolves to pursue the least competitive things that we just don't see in many areas anymore. So if I answer that question in crypto, I think, the next 5-10 years, it's like the analysts are going to start covering it. And there's academic papers being written about owning things before the analyst covers it. But we should end with a more balanced and professional capital allocation process that can create a more normal market structure. And family offices should be the first movers, and they're, going to liquid funds, like you should be the ones benefiting from that. There's a discussion about crypto as a whole being less reflexive and more institutionalized. I think we're still pretty far from that, but I could see over a 10-year period us starting to approach that point. There's another risk factor to think about, kind of a bit more hand wavy, is I think it was probably this trend of money going into more reflexive assets generally. I'd say the more we progress into the world of money printing, it feels like the more reflexive things get, more money in the system, things become distorted and the fundamentals sort of become fuzzier. And so money, I think, just tends to go into more meme investing, and not just meme coins, but, Tesla had a good day today, up almost the entire market cap of altcoins and crypto. But just this nihilistic form of investing with decreasingly rigorous fundamentals being the marginal price setter. I think that's a secular trend, and being a part of the crypto adoption trade is an obvious way for me to play that. And the last point I'll make here is it's sort of related. There is just going to be this large wealth transfer to people who are more digitally inclined. So, the skeptical boomers are going to give the money to the nihilistic millennials, and every family office has different priorities. But if your kids are going to buy a bunch of crypto anyway, you might as well help them do it responsibly by engaging in this now.
Well said. Probably heading to my final 2. As family offices increasingly invest in digital assets, that's a hope, but you gave one reason why that likely is to enhance even further. how should they balance innovation with long-term security and risk management?
I guess we kind of made it to the end, right? I guess, my Bitcoin views aren't that novel, but in Bitcoin, to be fair, it's been a bit of a chameleon over time. But at this point, I think it's had a pretty strong role in portfolios. BlackRock wrote this piece. They called it the unique diversifier. I thought it was a pretty good piece. People can go get it. It's on the internet. But Bitcoin does well, and it's not exactly like gold. It does have these different characteristics, and people get confused. Is it a risk asset? Is it a hedge on inflation? It seems to do well when there's concerns over monetary stability, geopolitical stability, U.S. fiscal stability, U.S. fiscal and U.S. political stability, and it has very unique characteristics for that. And these have been conversations we've had on the macro side for 15 years, but now they all are starting to feel much more real. And my mindset has always been, once policymakers are given an option to use these monetary tools and fiscal discipline goes away, we're just going to end up at the point, to Paul Tudor Jones's speech or comments the other day, all roads lead in the same direction. And so I think the endpoint's pretty clear, and Bitcoin can play a really interesting role in your portfolio. So to answer your question, you kind of have these two separate positions, despite all the correlation. You have Bitcoin, which can play this really great role in a portfolio, diversifying a bunch of stuff, but try not to let the correlation to this other part of your portfolio. If you have both Bitcoin and then, crypto venture or trading funds or Solana, whatever, try not to let the correlation of those two things affect your ability to hold on to the Bitcoin. And sort of mentioned that earlier, but, it feels like that, there can be asynchronous moves in the Bitcoin thing. It's all these things, none of these themes are new, but they all just started being more important. And so it's hard to get the timing right on when the adoption trade of Bitcoin happens, because these themes take large steps forward. So I think the balance is tricky. You wouldn't want too much P&L swings in your crypto VC to affect your Bitcoin holding, and trying to find ways to separate out those buckets helps you be more responsible about it.
And David, I'll give you a chance to maybe have a final word. And again, our special guest today is David Kalk, Kalk, and an opportunity for those that would like to learn more about your work that are, I'm assuming, qualified purchasers and above. How could they do so?
Yeah, we like a lot of hedge funds, don't have a very large presence on the internet, but IR at reflexive.xyz. Reflexive.xyz is our website. Happy to engage in discussions where appropriate.
Excellent. And I'll give a little bit of a closing commentary. It was great to have David on today. He has a tremendous background. And again, I haven't covered broadly crypto as much as I probably should this past year. So it was great to have such a guest that had wonderful value. And depending on audience interaction and interest, I'm happy to do more. Perhaps even getting, and I've reached out to him and he seemed open to it, Michael Saylor back again. So that would be very, very exciting. And I just asked family offices that I think we noted earlier, this is a different stage than it was a couple of years ago. Dynamics are changing. Dynamics in the family are changing. And you don't want to miss out on opportunities. At least form a thesis and have an opportunity to say yes or no. When maybe, like we mentioned, that Raul and others mentioned, maybe, although maybe not, I'm the biggest advocate of being overly diversified, maybe for something like this, it's at least a good starting point. So the opportunity and understanding those markets, I think, are going to be important for family offices moving forward. And the industry has been a little slow, but that doesn't mean that you want to be average. You want to be above average. You want to at least put in the thought and form the thesis. So on that note, I hope you all enjoyed it, everyone. And I will give, perhaps before I give my final in terms of my information, do understand that both for myself and David, we're imparting our views at this specific time. Happens to be late October in 2024. There are a million different things that could happen: interest rates, inflation, geopolitical war, that could change the dynamics of our opinions moving forward. You may watch or hear this video a date from now, may be different, a year from now, perhaps even 10 years from now. So conditions change and opinions change. Do understand that when you invest, you should understand your risk tolerance, your liquidity needs, and your specific situation. Everyone is different. David mentioned great verbiage like first principles thinking, like thinking for yourself. You should all know what that means. And actually, going back to Saylor, when I had him on and I asked him what's the greatest value he got out of MIT, he said learning to think for himself. So you all should form your own thesis and think for yourself. And when you invest, you can lose money. Do understand that. So be careful and be appropriate relative to your current situation. Everyone, I'm Angelo Robles. You could follow me on YouTube at Family Office and at Family Office TV, on Angelo Robles Podcast, Apple and Spotify and others, and go to angelorobles.com. Learn more broadly about my services, including becoming a member, if qualified, as a family or family office executive of SFO Continuity. I've been in the community a long time. I have a lot of thoughts. I'm not saying they're all right, but I'm a bit of an out-of-the-box kind of seeing around the corner thinker on practice management and best practices and really anything to do. It's my obsession with quote unquote single family offices. So we would love for you to consider joining and being a part of what I'm building. And again, that's at angelorobles.com. I appreciate all of you, David coming on as a guest, and hope you all have a great day.